So Warren's going to be looking at FX on Webtrader. We're looking at probably about 20 minutes or so. We got some time for some Q&A. We're going to be doing these every Tuesday during May, 10 a.m. I know the system said PM. I will correct that for the next series. But every Tuesday during May, we will run one of these, and we will evolve them over time. As always, we are recording. But Warren, over to you.
Thank you, Simon. Welcome, everyone. Today we're going to be looking at Forex, and we're going to start with some basics. Forex trading is really when we compare one country to another in terms of interest rates. That's basically the bottom line of currencies. The reality is it's more the expectation of changes in interest rates that we trade. And this tends to make currencies trend quite well. If one country's economic outlook is better than another's, the market would expect inflation to increase, so prices will rise in that country and thereby drive interest rates higher as the Reserve Bank attempts to control that inflation. If the opposite country has a stable outlook and low expectation of change, its currency will lose ground against the first currency as money flows from one to the other. So money is always looking for a better yield, and that's why QE has driven stock markets higher, because the market's always looking for a yield because interest rates are low. And they find it in the stock market, and currencies work on a similar basis. If the US dollar has a better interest rate than the euro, then money will flow into the US dollar, but it's normally done on expectations. In other words, US dollar has been rising for about 12 months now, and the interest rate hasn't actually changed. So the market was betting on a change, and it hasn't happened just yet. This is what is known as an interest rate differential. So it's the difference between two countries' interest rates. Major and minor currencies, there's quite an important distinction here. The major currencies are the United States dollar, the Canadian dollar, the Australian dollar, the Japanese yen, the euro, and the British pound. Those currencies make up the majority of daily Forex volume and have high liquidity. High liquidity just means that currency flows a little bit better. When we look at minor currencies, all the other currencies are minor currencies. They generally have lower liquidity and therefore can suffer large and sudden moves. So any of you that watch the rand can move 5 cents in a day. It's highly unlikely that the euro dollar will do something like that. So the dollar rand can move pretty quick, but the euro dollar would move a little bit slower. And the big danger is when you're caught on the wrong side of a minor currency, it can be very difficult to get out at your stop loss price. Usually it'll just gap straight past it. So please, guys, try and stick to the majors in the beginning for the first year or two, and then you can start to dabble in the minors when you have an idea of what you're doing. Some of the important economic indicators to watch out for: GDP, and these numbers are announced quarterly, and they are used as a measure of an economy's overall health. So GDP growth is quite important. If GDP is growing, then the economy is deemed healthy. The market watches the CPI, so Consumer Price Index. The Fed uses inflation figures to assist with interest rate decisions. If inflation is rising, the Fed is going to, or any Federal Reserve Bank is going to slowly increase interest rates to reduce that inflation over time. Non-farm payrolls is a big American number. It is the estimated number of payroll jobs in the non-farming related businesses and government departments. Those numbers are announced monthly on the first Friday of the month. And those are the big numbers every month. This week will be non-farm payrolls. And you can keep an eye on it and see how any of the US dollar pairs change with those numbers if there is a bit of a shock. Every country has these announcements, and major changes in either currency in a pair can affect the price of that pair. So if there's news out of the dollar, but there's nothing out of Europe, the euro dollar can still move based on dollar strength or weakness. So these are quite important. There are quite a few of these indicators. You're going to have to read up on them, put a little bit of effort into understanding what they mean and when they're expected out. This forms part of the news. So those economic indicators form part of the news that every Forex trader talks about. In general, the news can affect a currency. And as a Forex trader, you should be aware of important events on the calendar. The news releases are looked at for some sort of guidance as to what the Reserve Bank of that country is likely to do about those interest rates. So if there's economic growth, at some point that country is expected to increase its interest rates. If the economy is improving, the market will expect some interest rate increases going forward, but if unemployment is increasing, the bank is unlikely to increase interest rates too much, as the economy would not be able to absorb the rising costs. So it's quite an intricate thing, and this is very much a simplified version of events. All right, so plenty of news things to sort of catch up on, and almost on a daily basis there will be something out on one of the currencies. Now we get to the trend. Major news events very seldom change a currency's long-term trend, but tend to reinforce it in some way. So news spikes are the normal reaction to unexpected news, good or bad, and they can cause short-lived counter-trend moves depending on the time frame. Those counter-trend moves, if you're a longer-term trader, those counter-trend moves are what you're looking for to increase your position in a particular pair. So the news spikes can be used to get back into the trend if you're out, or add to a winning position. Bottom line is that the currency's trend is based on expectations rather than facts, and that's why technical analysis is a good way to identify these trends and trade them, because the market's always moving way before the announcements are made. Politics also plays a role, as the market generally interprets policy back into interest rate expectations, or in a country's ability to pay their bonds, for instance. So you do have to keep an eye on politics, and that's why at the moment the British pound is a bit difficult. They've got a general election going on, so I'm staying away from the pound pairs at the moment until that election is over. Once there's a clear winner, we'll have an idea what to expect from the British. Obviously, there's a lot more detail and complexity involved, and this is a very broad overview. Currency pairs, and this is what they look like. A pair is made up of a base currency. We have a look. This is called the trade board. Obviously, there'll be more currencies offered on a trade board. I've just picked the euro dollar, and this is where you would actually place your trades on the currency that you're looking at. And we can see here the sell is done at the bid price, so we sell at 1.11468, and if you wanted to buy, we would then buy at the asking price. The spread, the difference between the bid and the ask, is our trading cost, and the bottom number here is the exposure value, and it's always quoted in the base currency. So you'll see it's 25,000 euros exposure to make this trade. As the relevant exit price changes, so if you do go long, you have to sell to close the trade, and you'd be selling at that price. And if that is higher or better than your entry price, you're going to make a profit. If that is worse than your entry price, you're going to make a loss. So the same idea as any trading. So any share trade that you do, same idea. It's just currencies tend to move a little bit quicker. Open positions and profit and loss. A short position was open on the euro dollar at 11649, and at the time of printing here, it could have been closed at 397, would have given us a profit of $43. And you can just see your opening price over there, your closing price there, and your profit and loss in that column. And the value per tick, which is as your closing price changes, depends on your exposure value. So the smaller you make this number, the smaller the dollar per tick change. And the tick is the 5th decimal place, the little small one over there. Some technical analysis. A chart is a chart. If you look at those two pictures without knowing what they are, you're not really able to tell what time frame they are, what instrument they are. So a chart is basically a chart. Any technical analysis that you know can be applied to currencies. And the difference here was that the left-hand chart was the euro dollar 1 hour, and the right-hand chart was an Aussie 5 minutes. So always remember that the only thing that changes between instruments and time frames is the size of your stops and targets. Okay, so on a 5-minute chart, your target is going to be, your stop loss will be smaller than it would be on an hourly chart. So the bigger the time frame, the more capital generally you should have in the account, or the smaller the trade size should be. Smaller time frames require more of the trader's time and focus. I know it's quite attractive. People want to trade these 5-minute charts or smaller, even 2-minute charts, because you're going to get more trades there, but you have to have the time to do that, and you have to be prepared to take regular trades, let's say 4 or 5 trades a day, and that can be quite tiring. And on the other hand, it can be quite boring as well. Then you tend to force trades. So just be careful of the time frame. Go and play around with them. Find one that suits the amount of time you have to trade, and what suits your risk analysis. Okay, currencies trend, and they can trend really well on the daily chart. This enables us to identify trends with difference and consistency. Now, I don't change my settings. I always use a 21 and 89 exponential moving average for trend analysis, and I do that on everything I trade. If the 21 is above the 89, the trend is up. If the 21 is below the 89, I consider the trend to be down. So it's very clear-cut, black and white. Once we have a consistent measure, it becomes simpler to backtest and identify high probability trades as well as switch markets. So once you have a system that you really trust and understand, you can take that system to any market, backtest it, and make sure that it works on your particular instrument. So what I've got here is I've got the Euro-US dollar daily chart with the 21 and 89 EMAs, and since May, since they crossed over there, this trend is down, and the idea would be finding trades in the direction of that trend. In other words, not trying to pick the bottoms. We're not trying to pick this point here to go long. I'm basically saying that as long as those two averages are down, I'm looking to short the euro dollar. Chart patterns can then be applied as well, just as an introduction to some basic techniques. The trend changed over here. 21 crossed to 89, the market fell, and in this area here, we can see a bear flag. The market breaks the bear flag over there. You take a position short, and your chart pattern rules don't change. So stop loss would have been top of the pattern. Market never got there. You're holding the position. It breaks through the support line on the bear flag. You could have added another contract in there, and your stop loss would generally, I look at it as halfway between the top of the flag and the bottom of the flag to exit the second trade. Never happened, and the market continued to fall. So once you identify the trend, all we try and do is find trades in that direction. Trying to pick those ultimate turning points is much harder than trading with the trend and more costly. You're only going to be right once. It can be highly profitable, of course, but you're only going to be right once. And in the beginning, I recommend rather looking for trends. If the market is trending down strongly, trade that direction. The other side, of course, is the history of the chart. You should go and check the history. One trade like this doesn't make a trending pair. So for instance, if you go and have a look at the Australian dollar, US dollar, it's done incredibly well in this last year, but the previous 5 years were horrible trading that thing on a trend basis. So I generally would take smaller positions in the Australian dollar, US dollar, just knowing the history of the chart. Okay, so it's not clean cut, but there are currencies that do trend well. Go and backtest, go look for those currency pairs, and then trade the direction of those trends. Thank you very much, guys. Please feel free to ask some questions.
Thanks, Warren. Folks, send your questions in. Question around slides for later review. Yep, the video will be up online in a couple of hours. Citrix will automatically send you a link for the video as well, so that will be available. Warren, a question coming through, and there's 2 or 3 of them that are sort of merging. Some came on Twitter. Looking for sort of a novice, a first-time user, is there one secret you're going to give to them and say, this is it, this is what's most important?
What I just showed them on the euro dollar. Certainly identify a strongly trending pair that has a history of trend as well. So in history, I mean 3 years plus.
Yeah.
If you go look at the euro dollar, and if you just traded 20 on crossing 89, you would have made money over the last 5 years. So go look for currencies like that.
Another question coming through, particularly around time frames. You said stay away from the shorter ones. Question has heard a lot that the 4-hour is a decent time frame for currency markets. Your take on that?
Yeah, absolutely. There's a nice, on a 4-hour chart, there's a nice balance between volatility and trend. So if you just apply your daily trend and trade your 4-hour in the direction of that trend, you're going to get more trades, and they'll be over shorter periods of time. And the 4-hour is the most popular time frame on currencies.
Yeah, I know a couple of guys who only trade the FX in 4 hours. It does mean that their candles at midnight and 4 a.m., but well, I don't know, maybe you're an insomniac in that space.
Yeah.
And another question, Warren, is there a particular pair that you prefer trading, like US dollar, euro, or something?
Look, I enjoy the euro, US dollar, and the US dollar, Canadian dollar.
Mm-hmm.
I've been trading them for so long, I pretty much understand their economics. So those are my two favorite pairs, but I'm not really fussy on the major side. I do, however, I trade the Australian dollar or the Swiss franc very small. I don't like big positions on those two. They're a little bit unpredictable.
What about those? I mean, you mentioned up front the minor currencies, of which the rand is one, and all the emerging market currencies, etc. And you said they're more volatile, etc. Is it not a case to be made to just stay away from them and then trade the majors?
Oh yeah, absolutely. You know, if I look at these miners, if I ever trade them, which is maybe once every 2 years, it's always a small position, and it's more for fun than anything else. I do find it very difficult to be consistent on them, and that's just purely your risk reward goes out of the window with those currencies because they've got these big jumps.
Yeah, and we see it in the
Support
rand.
doesn't count as support.
Yeah, the moves in the rand can be massive. And Stefan's then asking about risk management. He says, would you use pretty much the same risk management strategies as you would if you were trading, in his case, he says CFDs, but pretty much whatever you're trading, you can come in and do your risk management, your 2% rules and the like.
No. Forex, it depends again, I suppose. I say no definitively because
You
I
did.
like to trade many things. I like to trade many things, and if I use a 2% rule, I don't want to expose my more than 10% of my portfolio to risk at one time.
Mm-hmm.
So I'm using between 0.5% and 1% as a risk guideline.
Okay.
Obviously, because also I'm building positions so that as the position goes into profit, you can take more trades because your position's in a bigger profit. But the starting rule is 0.5% to 1% of capital.
Okay, and I like your point of building the positions. In essence, you're scaling into the winners. I mean, we stress here not the losers, but you scale into winners.
That's what I try and do, yes.
Ladies and gents, not seeing any more questions coming through. As I said, the video will be available in a couple of hours' time. And then we will certainly also we'll be back again every other Tuesday during the month of May, 10 a.m. A question coming through. What about pound Oz dollar? I know you said you don't like the pound at the moment, Warren, because of the elections coming up. Let's assume that's Thursday, so sort of from next week, things would hopefully have settled down. Is pound Oz dollar ever on your list?
No.
No, fair question.
The Aussie dollar, look, the Australian Reserve Bank is quite, I don't know what the right word is, probably diligent.
Mm-hmm.
They actually wait to see whether their interest rate drop has made an impact on their economy. So it's very difficult to predict what they're going to do next. Whereas, like the US, once they start, they don't stop so easily.
Okay.
So they get a trend on the interest rate increase or decrease. Whereas Australia always waits. They wait like 3 months before they decide what they're going to do at the next meeting.
Yeah.
Which makes it very difficult to predict. What's going to happen. So the market's expecting the Aussie dollar, the Aussies to reduce interest rates in the future. Yet the Australian dollar has strengthened, and it has been very volatile for the last sort of month and a half, 2 months.
What about a question coming through here about New Zealand versus USD? I know at one point, and I'm racking into my brain, you traded something around the New Zealand dollar, but I don't know if you still do.
Yeah. The New Zealand dollar is similar to the Aussie. It is a minor currency, firstly. I normally use the New Zealand dollar as part of my relative strength calculations, and that's just to add weight into the Aussie and the US. But it's not something I trade very often. It is one of those where if I get a really good, solid setup, I'll make the trade because I'm almost guaranteed that if it works, I'm going to make the money twice as fast as I do anywhere else.
Gotcha.
but it's not something I trade regularly.
A couple of folks asking about dollar yen now. I mean, and there are a couple of questions around it. Dollar yen used to be before the before the euro. It was sort of dollar sterling cable, and then dollar